This is one of the most frustrating experiences in trading, where you think that you've properly done your analysis, then you enter with a buy position on an uptrend to take the market into trend continuation. But in reality, this is what happens. You get stopped out and left thinking on what have you done wrong. Well, in this video, we will target to have the best and yet simplest way of analyzing the market and planning a setup that works with the trend. So you can then get these type of setups as well. So let's get into it. On the S&P inside the 1 hour time frame, it's quite easier here to see the trend from a straight view. It's a clear high time frame downtrend, where the market pulls back to the upside, forming these swing highs that if you look on the left of these swing highs, a lot of times you're going to see that the market formed a supply on the left, and the new swing high fills that certain supply level, pushing back down away from the supply, breaking down below the swing lows. The simplest setup from supply levels, you probably already know them by now. It's literally just selling short from the supply with the stop loss above, and the take profit expecting the last swing low to be broken down, since this is a downtrend. Now this was a crazy rare trade that I'm sure some of my viewers took. A setup that gives such a high risk-reward ratio happens quite rare. But we are not here to trade on past candles. We are here to trade on future candles by constantly analyzing the price action. Because it's easy to talk about what happened, but hard to tell what's probably going to happen next. So we move into the most recent movements. Here we've had on the external swing levels an impulse to the upside. This impulse breaks above the last swing high, so we turn from external swing lower highs into the first swing higher high. When this happens, that prints the first reversal from a downtrend into an uptrend. That's also called as a market structure shift, or a change of character towards the bullish side. They're basically the same. You probably heard both names. They're the same concept under a different name, and on the internal levels it's seen as an uptrend. Basically both are aligned together. Now when a significant break of the swing levels happen, we carefully watch the price action and market structure that has led to that point. Here, for example, we have all the candles closing bullish, with larger lower wicks, but still closing bullish. The psychology of these types of candles basically say that sellers tried to push the market down, but they did not have enough strength, because every move was quickly bought. It's important to think like the market is a battle of buyers against sellers, because the market always looks to be efficient, and when efficiency breaks and the market becomes inefficient, just like this move where buyers had a huge advantage over sellers, the market looks to recalibrate or rebalance. Basically, to come back into efficiency, said in other terms, we should soon be expecting some sort of downside pullback. We just don't know where it will happen. But when it does happen, we will be looking for buying opportunities near demand levels, support levels, or whatever bullish entry structures we're using. And that's because why should we look for sells if the market is still on an uptrend? It makes no logical sense. Seems like this upwards action continues, but bearish candles start appearing more often, and here we even had a downside pullback. Of course, that got faded to the upside and broke the last high, but that's a normal price action during an uptrend. Now, after a break of structure, so basically after the break of the last high, it confirms the higher low, from where we got a higher high since the market basically continued the uptrend, and after a higher high has been set, during an uptrend we look for the next higher low. The new higher low validates as long as the market stays above this level, meaning that it should not break below this because that would confirm a lower low. So assuming that it won't break, this could become a great opportunity to look for a buy-long setup in order to follow the trend higher. We can use a demand level as a structural entry for a setup like that. But we need to identify that demand. The theory of the demand is that it's the last bearish candle before the market started a significant upwards push. For example, this is the last bearish candle before a small upside impulse. But here we see that this demand already kind of got filled here, this slightly decreasing its quality. For a higher quality demand, we want to see a level that has not been filled yet by any wick or candle. There is another pair of candles right next to the last ones, where we have an impulse to the upside, and before that impulse, we have a bearish candle. This can also be a demand, and this one did not get filled yet. But the problem with this demand is that the entire zone is quite large. So instead of trading this demand, we will just use it as a trend validator, where we will use timeframe confluence, basically lowering timeframes, and we spot there the actual setups. But until then, we need to wait for the market to hopefully fill this demand, which it did a couple hours later. Now, if we analyze the market's swing levels that led to this point, we have the upwards push, a pullback, continuation to the upside, which breaks the past high, then a pullback again, and another continuation. But then we see this increased selling pressure driving the market down. So we see that we've had higher lows, but now we have a lower low. The mistake a lot of traders make is they instantly assume that we're now reversing into a downtrend, because we formed the bearish reversal. So the market structure shifts since we broke below the last low. The problem in this is that the market had to break below these lows anyways, else this demand would not fill. So if we're just ignoring the demand, we can say that we're probably going to pull back to the upside and reject down from a supply or resistance. So we can then form the first lower high, and coupled with the previous lower low, now the chances of the downtrend respecting are higher. But if we think this way, we're basically ignoring the demand, and keep in mind high time frame demands are high priority, and it's quite logic that for the demand to fill, the market has to go down below this low, so the chances are that this is not an actual valid bearish trend shift. And now that we've filled the high time frame demand, we can lower down time frames and see with more accuracy how the price action reacts while inside the demand. Because on a lower time frame, we see the same price but in more detail. This is on the 5-minute chart, and we zoom on the candles that filled the demand and the candles that are inside the demand. Around here should be fine. And of course, the price action that led to the market filling this demand was a downtrend. On downtrends, the market breaks the last lows and pulls back to the upside, the pullbacks usually ending on supply levels, from where the market rejects from them into downtrend continuation. For example, here, we have the last supply, but this supply is inside the demand, and the demand is on the higher time frame, so the demand takes priority over this internal low time frame supply. So at best you can scalp this supply, but it's way too risky since we're inside a high time frame demand, and the market can reverse back up at any moment. Just like here, on the recent price action, where it's starting to look like we're reversing back to the upside, basically seeing a bullish reaction from the high time frame demand. But the sell-biased traders look at how this supply has filled and rejected back down, and they're probably looking to exit with a take-profit target below the last swing low. However, the market straight up breaks above their supply, stopping them out. This concept of structural priority is extremely important, because structurally, sell-biased traders were right. Since we see a downtrend, it's actually common for supply levels to respect. But they completely ignore the high time frame demand, and higher time frame structures will respect more often than lower time frame ones. Especially when there is a low time frame supply that's inside a high time frame demand, well, then what has a higher probability of respecting? Because the supply is bearish, but the demand is bullish, so they're two completely different structures moving in two completely different directions. In that case, the high time frame one stakes priority, being the demand in this specific scenario. The only scenario where the low time frame has the same quality as the high time frame is when, for example, in this market we've had an internal downtrend that filled the external demand, and then we've had an internal reversal into an uptrend out from this demand. So basically both trends, the internal and external, are aligned together, both moving to the upside. In this scenario, we can trade the internal structures since they're being validated by the external one. So basically that means that we can look for an internal demand inside the external demand. The internal demand should be found right before the upside impulse, around here, and more specific on the last bearish candle, that also leaves this wick. So far this is what we're having, seen on the 5-minute chart. The price just leaving the high time frame demand, so it's validating the bounce. Now that we've confirmed the low time frame internal demand, which we will be using for the setup itself, and we see the bounce out from the external demand, we can come back into the previous time frame, back into the 1-hour chart. Here, now that we've found the low time frame demand inside the high time frame demand, we no longer need the high time frame one. And keep in mind, this market structure shift is not confirmed yet. For it to confirm, the market needs to fill this potential supply, which, by the way, is also not valid right now, since we're still in a high time frame uptrend. So until the market breaks past the low that formed the internal demand, the market is still both internally and externally following an uptrend. So we can now plan a setup from this internal low time frame demand. Structurally, the stop loss would be placed below the internal demand. But a safer entry for a swing trade would be below the high time frame demand. So we're just using the low time frame as entry confirmation, and the high time frame for the exit targets. And for the take profit, the first target would be at the potential supply. That makes sense if you think that we're reversed into a high time frame downtrend. You're basically saying that you don't expect a higher high, but you expect a lower high. But since the high time frame structure is currently in an uptrend and has been for some time, we can swing trade this into another higher high We've basically had higher highs constantly, so it would be quite unlucky if exactly when we enter the market stops forming higher highs. It filled the internal demand, opening the order, and jumping back to the upside exactly on the next candle. So now we've basically filled this potential supply, and it also kind of rejected with a bearish candle to the downside. But the bullish pressure comes back again, forming a higher low. This higher low, if we look on the left of it, we can see a demand that respected. This is important to know, because if you look at the price action, we're so far forming an uptrend structure of higher highs with higher lows. So there's no point in being bearish. And also the supply broke slightly to the upside later, so it invalidates even more. And the probability is that we will break even higher to the upside, just like we've done before, of breaking past highs. Which is what it has done a few hours later. Now this trading approach might seem complicated at first, but all that we're doing is just looking for buying opportunities on the swing lows during an uptrend, but doing so inside the low time frame, and exiting on a swing high on the high time frame. This was the simplest form I could go into this way of price action analysis and setup planning. I suggest you watch more of my videos so you get a more detailed view of how to implement this properly into your trading. And you can also find on my program, which goes into more concepts and situations you might find in the market. You can find it on the link in the description, and until then, have a great trading week.